Dear students, knowledge seekers, and learners, welcome to lecture 1 of week 3, wherein we are going to discuss and understand types of financial markets. In today's lecture, we are going to start with concept of financial market classification, followed by basis of financial market classification. After that, we will try to differentiate between money market and capital market. After that, we will try to differentiate between primary market and secondary market. Followed by, we'll discuss another type of classification wherein we'll try to understand the differences between organized financial market and unorganized financial markets. Subsequently, we will also try to understand the differences that arises between the domestic financial markets and international financial markets. In the end, we'll try to develop and understand the interrelationship among different types of financial markets. Let us begin the journey. At the outset, a question arises in our minds. What is the need to classify financial markets into different types? Is it logical? Is it required? Is it making things simpler, etc.? We all are aware that financial markets are diverse as well as complex. The diversity and complexity provides and gives certain challenges for the people and the entities. Thus, classification helps to understand different functions within different financial markets. The classification of financial markets also help to identify participants and instruments. Financial markets also analyze the market behavior. Together, all these three things make financial market accessible, simple, and promotes logical decisions within the financial markets. In addition to this, classification improves clarity and analytical understanding, which indicates prevalence of logic in financial decisions. Thus, we can appreciate that all these attributes and advantages we get when we classify financial markets. Let us now understand the plausible basis of classification of the financial markets. Financial markets can be classified based on maturity of funds, which means after which time the funds will get matured. For example, after 5 years, the funds will be matured. Maturity of funds means either repayment of the borrowings or the time in which the money will be fully utilized. The second basis is nature of claims. The claims will be monthly, quarterly, or annually. This is what will also, it can also include the claims will be fixed or variable. Another classification basis is stage of issue. It is the first stage issue, or second, or recurring. Similarly, another one, that is another basis of classification, is geographic scope. It is limited to a geographical boundary, or it is cross border. Another basis of classification is degree of regulation. Means it is regulated by RBI, SEBI, IRDAI, etc. So all these bases of classification are logical and they specify things from one perspective and they add value to the decision making. Each classification highlights a different dimension of markets. Let us now try to understand each one of them separately and in detail. The first basis of classification is classification by maturity. If we talk about maturity, then financial markets can be divided into two types, money market and capital market. In money market, the maturity of funds is for less than 1 year or equal to 1 year. Thus, they are short-term funds. In comparison to money markets, capital markets are where the maturity period is more than 1 year and that is why the focus is on long-term funds. Classification by maturity is the most fundamental classification and through this decisions can be simplified and be made logical. For example, Mr. A wants to invest some amount of money, say for example 10,000 rupees in an investment option. Mr. A wants to invest for some future contingencies and he expects that the future contingencies may arise between 2 to 3 years. Now, Mr. X is very much clear about the maturity of the money which he is investing. Now, 2 to 3 years means that this is a long-term fund and therefore Mr. A knows that he needs to invest this fund in capital market. Suppose, in contrast to this, Mr. X wants to invest in any investment avenue with a requirement of 35 days. Now, according to maturity classification, it is very clear this 35 days will fall under money market, which makes his decision easier and logical that he needs to invest in money market. Let us now try to develop a conceptual understanding of money market. Money market deals with short-term financial instruments. Now, when we say that we deal in short-term financial instruments, it is very interesting and important. The focus of money market is on liquidity management. Liquidity management refers to management of current assets and current liabilities. So, investment is being done in short-term financial instrument with the objective that the current assets and current liabilities of the firm may be managed properly. Another focus is on working capital needs, which again targets at current assets and current liabilities. Both these requirements of liquidity and working capital is very important for business entities and money market provides a plausible solution for these problems. The question arises that who all are the participants of money market? The participants of money market include banks, includes financial institutions, as well as government. The money market ensures short-term financial stability within Indian financial system. Let us now try to develop the conceptual understanding of capital market. Capital market deals with long-term financial assets where the maturity is more than 1 year. The focus of capital market is on investment as well as capital formation. Both investment and capital formation are interesting and they can add value to those funds which are invested for more than 1 year. There are different participants in the capital market. The participants of capital market include corporates, include investors, as well as government. The participants enjoy the financial instruments that are being traded in the capital market. Thus, capital market supports long-term economic growth in any economy. Let us now try to differentiate between money market and capital market. On the basis of duration, money market is short duration while the capital market is long-term duration. With respect to purpose, the purpose of money market is liquidity while the purpose of capital market is investment. With respect to risk, in money market, the risk is lower in comparison to capital market, and in capital market, the risk is higher. With respect to instruments, in money market, we have all type of short-term instruments like promissory notes, marketable securities, commercial papers, etc. On the other hand, in capital market, we have long-term instruments such as debentures, shares, etc. We need to understand and remember that different markets serve different financial needs. Therefore, both money market and capital market are important, yet they have their different instruments and attributes. Let us now move to another classification, which is by stage of issue. The issue stage can be divided into two types of market. The primary market, wherein securities are issued afresh, or for the first time. On the other hand, secondary markets are where already issued securities are being traded. Classification by stage of issue is based on whether securities are new or already issued. This classification gives insight to investors whether they want to buy already traded securities or they want to buy securities that are offered for the first time. Let us now try to understand the concept of primary market. The primary market are for new securities, and these new securities are being issued for the first time. The functions of primary market includes capital raising as well as allocation of new funds. This capital raising and allocation of new funds are really important and they push primary market to a new level. The participants in a primary market include issuers as well as investors. Issuers are the entities that are issuing the shares while investors are buying the shares. Thus, issuers can be in simple parlance termed as sellers and investors are buyers. Primary market is thus the entry point of securities into the system. Let us now try to understand the concept of secondary market. Secondary market in the financial markets are markets for existing securities, means the security always being traded. The functions of secondary market include trading, liquidity provision, etc. The trading and liquidity provisions are very important and interesting. Secondary market ensures continuous valuation of assets and they provide a great opportunity. Let us now try to understand the difference between primary and secondary market. From the perspective of securities, in primary market, new securities are being issued that are issued for the first time. On the other hand, in secondary market, the existing securities are being issued. The purpose of primary market is fundraising, while the purpose of secondary market is trading of the existing securities. With respect to participant, the participants under the primary market includes issuers and investors, while the participants in the secondary market includes only investors. It is to be noted that in a financial market, both primary and secondary markets are interdependent. There is also another classification by regulation. Let us now delve into that classification. Based on regulation, market can be classified as organized and unorganized markets. The organized markets are those that follow formal structure and regulation, while unorganized markets do not follow the formal regulation and structure. Thus, these classifications are based on the degree of regulation. Let's try to understand the concept of organized financial markets. Organized financial markets operate under formal rules that are applicable in India. The features of organized financial markets includes transparency, that is disclosure of all necessary information relevant to the stakeholders. The second feature is regulation. They follow the rule of law strictly. Another feature of organized financial markets is standardized practices, that is, practices that can be used to relate to and to measure their effectiveness. An example of organized financial markets is stock exchanges. Let us now try to understand the unorganized financial markets. The unorganized financial markets are informal and less regulated. Informal and less regulated, unorganized financial markets are relevant and important, and its features includes flexibility and lack of transparency. Both flexibility and lack of transparency are very important constraints. The example of unorganized financial markets include informal lending networks. These informal lending networks are very relevant and they always try to add value to the organization. Let us now try to understand classification by geography. Classification by geography means that we try to classify market based on boundaries. Based on this, we have two types of classification: domestic financial markets and international financial markets. So, in simple words, domestic financial markets always work within a geographical and political boundary, say for example India. So, all those that are working within India are domestic financial markets. On the other hand, international financial markets, they are cross-border markets. Thus, a financial entity that is operating in India and it's also part of United States of America will fall under international markets, while one firm which is only in domestic country will be under the domestic financial market. Thus, this classification is based on geographic scope. It is time to understand the concept of domestic financial markets. Domestic financial markets operate within a country, so their scope is limited and they only applies to a political boundary of a country. Domestic financial markets are regulated by national regulations which are formed by the government of that particular country. Example of domestic financial markets includes Indian financial market. On the other hand, let us now try to understand the concept of international financial markets. International financial markets facilitates cross-border financial transactions. These cross-border financial transactions are very relevant and they are important for the global economy as well as for the domestic economy to attract foreign direct investment and foreign portfolio investment. The international financial markets includes the foreign exchange market, which are known as forex in short, which facilitates the buying and selling of different foreign currencies. International financial markets also include global capital markets that facilitate cross-border capital flows, and international financial market thus facilitate global capital flow from one country to another country. Dear students, knowledge seekers and learners, there is a very important interrelationship among markets. We have been discussing and discussed the different classification of markets based on maturity, on geographical boundary, stage of issue, regulation. And in all those classification, we have seen that each and every classification serves a specific purpose. But the question remains whether these classifications are dependent or interdependent. Thus, there is an interrelationship among markets. For example, if we try to find out an interrelationship, say for example, is there a relationship between organized financial markets and say for example, the regulation? So when we say regulation, obviously we mean the classification based on regulation. Okay, and this classification is linked to organized or not. So these kind of questions of relationship are important because based on the answers, public policy or financial policy is being implemented. Not only this, these types of relationships also provide insights for reforming the financial system. So reforms are also not possible if we do not identify the interrelationship among different types of market. So, for example, money market supports liquidity. But only liquidity is not important for a financial system. Liquidity is for short term, but we also need long term investments. So then we have capital market that supports long term investment. Now, long term investment and liquidity is also linked together. If we do not have long term investment, we will not be able to require liquidity for running day-to-day operations. There will come at one point of time a plateau where liquidity will not be required because day-to-day operations are not required because there is no further investment. So it appears that money market and capital market are very separate, but the functions which these two are performing, they are linked together and they are complementing each other to collectively contribute towards economic growth and development. So liquidity and investment are imbibed together and they complement each other for achieving economic growth. Similarly, primary market, for example, it feeds secondary market. Without primary market, there is no possibility of secondary market. What are we saying in primary market? The shares will be issued when they are issued for the first time. They constitute the primary market. For example, Reliance shares. So first there will be IPO, initial public offering. Whenever there is IPO, this fresh issue of shares, it becomes the part of the primary market. But once they are into the market, there is no foundation. If somebody requires money, he or she can sell their Reliance shares in the financial market. How can we say that we will not allow somebody to sell what he possesses as a financial asset? So once this financial asset is being sold in the financial market, money is collected through the seller, the holder of the share. This share now goes into the secondary market. And in secondary market, now the trading of the share is possible. So we cannot imagine a secondary market without primary market. Thus again, primary market is the origin of secondary market. Also, primary markets depends on secondary markets because if a company wants to issue fresh new shares in the market, it tries to see its performance in the secondary market. Suppose the IPO of Reliance was for 1000 shares in 2024. Now in 2026, they want to again freshly issue 300 shares. Now, what will be the basis of issuing those 300 shares? The basis will be they will try to first see their performance of 1000 shares that have become part of secondary market now that are being traded in the financial market. After seeing the performance, they will try to decide that whether they should go for 300 or 200 or 400 and at what price they will offer. They will offer the shares at par, that is at the face value, or they will offer the share at premium, that is more than face value. These decisions will depend on the performance of their shares in the secondary market. Thus, primary markets also depends for decision making on secondary markets. So, these interrelationship among markets are very important as markets function as an integrated system, not just an isolated system. Let us now try to understand the functional linkages between these. Banks operate in both money and capital markets. Thus, they act as the functional linkages between money and capital markets. Similarly, investors move funds across markets, so they are also linking towards all the markets. Thus, because of functional linkages, the funds flow dynamically across segments. Let us now try to understand the importance of market classification. Market classification helps policymakers design regulations. In addition to this, market classification also assists investors in decision making. Market classification also enables better economic analysis, which helps to bring about the efficiency in financial markets. And market classification, which we have studied today, also is essential for understanding the financial systems. Dear students, knowledge seekers and learners, let us now summarize whatever we have discussed in today's lectures. We have discussed and understood that financial markets are classified based on multiple criteria. The key classifications of financial markets include the first classification, that is money market versus capital market. The second classification, primary market versus secondary market. The third classification, organized market versus unorganized markets. And the fourth and final classification, domestic financial market versus international financial markets. We have appreciated the point that each classification serves a distinct analytical purpose. Dear students, knowledge seekers and learners, thank you very much for being with me.